everybody, and welcome into this week's episode of the Magnify Wealth Podcast. I'm Cameron Gannon, and I'm here with my co-host,
Scott Gannon.
Today on the Magnify Wealth Podcast, we're going to be talking about understanding inflation and how you can combat it in your financial lifestyle. So, to get things kicked off, I want to talk a little bit about what inflation actually is. A lot of people think of inflation as rising prices. That's not what inflation actually is. Inflation can be in a few different things, and we're going to talk about them later on the pod, but these effects tend to cause rising prices. So rising prices isn't inflation itself, it's actually the result of inflation. So for the simplicity of this podcast, we're gonna talk about it in terms of rising prices, but we'll get into what actually causes that. Sure.
So really, inflation is the silent killer of your purchasing power, which, a quick example is if something costs you $100 today, and it's $200 5 years from now, then that is if all you did is have your $100 still in 5 years or sitting in a shoebox somewhere at home, it's only going to buy half what you had before, or you could have bought 5 years prior.
Alrighty, so like I said, inflation is actually what causes the prices to go up. So the first thing that can cause that is, from a technical term, it's called demand pull inflation. So that is when demand for goods and services is rising faster than supply is rising. So, a big cause of that in Canada, our population is rising. So there's more people that want goods and services. If the supply can't keep up, prices economically have to rise to find the economic equilibrium, if you will, just simply because there's not enough goods and services for the amount of people that want it.
Well, businesses are going to price according to demand and supply, and when demand exceeds supply, then prices rise. Same idea is, so what that does is that filters down to production as well, is raw goods will go up in price as well, for the simple reason that there's more demand for that, because, well, you know what, when there's higher demand, then end users will order more. So again, that's another reason. So it just filters through the system. And really where this all kind of starts is what we call monetary inflation. And that is, we call it the government printing money. Nowadays it's more digital. You just kind of create money out of nowhere. And let's face it, if you have $100 now and everybody else, it's like, I'll use the same example, just use $200 later. If everybody has $200 later, that would have bought 100, then now you've doubled the money supply. And that's not real growth, that's just inflationary.
Well, example I like to really make you understand what we call monetary inflation actually is. Picture you found a Michael Jordan rookie card in your attic one day, and you went and got it priced, and someone's like, you take it down to the pawn shop, they're like, we'll give you $1 million for this. This is really, really valuable. Well, now you wait a little bit to decide if you're gonna sell it, and in 2 weeks, 100,000 other people come forward and say, I found Michael Jordan rookie cards in my attic. Do you think you're still gonna be able to get $1 million for it? No, probably not, because now there's just more out there, so there's less demand for yours. Well, that's the same thing with money. When there's more money out there, there's less demand for your money.
Exactly. Yeah, good point.
So obviously in today's current climate, if you will, in Canada, these inflationary trends, namely the rise in demand and the rising money supply, are causing really, really large impacts in our society. With, you go down to the grocery store, you see the amount of food in your package is getting less, but the price is going up. The housing is out of control, and energy. You go on Facebook and all you see these days are people wondering why their energy bill is higher. Well, that's inflation.
Inflationary pressure, exactly. So let's talk a little bit about how inflation erodes your savings. So think of money sitting in a savings account. And let's just say that savings account is the bank's being really generous and paying you 3% interest on that. and inflation happens to be the same, 3%. Well, in a tax-free environment, that would be a net zero. You would replace the inflation with the interest rate, so your real return is zero. But what if it's taxable? Like most savings accounts are taxable, and then you're in a 50% tax bracket, then you're only netting 1.5%. So even though you're getting a 3% interest in a 3% in the inflation environment with taxes, you're actually going backwards. So you have less purchasing power at the end of one year than you did the prior year. And that is that's just going to eat away and erode your savings over time.
Yeah, and the same thing happens to investments that don't adjust for real returns. So let's say paper assets that are
bonds are a good example.
Yeah, exactly. Bonds are a great example because they they don't change in how much they're paying you. So when inflation goes up, the value will inevitably come down.
Exactly. And then of course you got tax involved in those as well.
Exactly. So how do you actually combat inflation? Since inflation is inevitable, we described it. We're not asking you to fix it. We're asking you to be aware of it and how you can combat it. So the first thing we like to talk about is, like I said, investing in real assets. So what's a real asset? It could be real estate, commodities. These assets tend to perform better during inflationary periods because people need them. People are still going to pay for real estate and for commodities. So, more money more money supply means more money that people are going to spend on them because like we said, the result of inflation is rising prices. Well, if you own a real asset, prices are going up on that too.
Yeah, and generally they should. I mean, in any given slice of a year or 6 months or a month or whatever, I mean, those things could obviously fluctuate in value just like anything else. But in general terms, real assets rise with inflation. They tend to if you look at real estate, historically houses, of course, we've gone through quite a run up here in the last few years here in Canada and in North America for that matter. But generally, if you look at history, housing keeps up with inflation, and that's basically it. I mean, the pockets of opportunity to gain more with real estate happen in more shorter term, in more pockets of economies and so on. So,
and not only the appreciation on the real estate, but rental incomes. Depending on where you're doing it, there could be some caps there, but they should, in essence, keep up with inflation as well.
Yeah, exactly. So if it's an income producing asset like a real estate rental or something, you should be able to benefit from both sides, the increasing value of the asset as well as the increasing rents. And we're going to get into the real benefit here in a minute with respect to real estate or to anything that you can use debt against. But you want to take it?
Yeah, let's jump right into it. So another strategy to combat inflation is using good debt to your advantage. So a good way to explain this is think about your mortgage, okay? On your mortgage, let's say you pay $2,500 a month. Let's keep it simple. If you're paying $2,500 a month today, now let's look 10 years from now. Assume everything else is the same. I know normally we're maxed out at 5 years here, but let's look 10 years from now and say you're still paying $2,500 on your mortgage. Well, if everything else costs more and you're now making more money because your income is rising with inflation, that mortgage payment feels a whole lot less drastic compared to today. So inflation actually is a bit of a hedge against inflation. So yes, it's been debt is a hedge against inflation. So you're essentially paying with cheaper money. So a mortgage feels a lot less drastic, but what we're going to talk about here is using good debt, like debt that actually helps you invest in real assets.
Income producing real assets. Yeah, so another side of this, so that's just your home mortgage, any mortgage for that matter. If you feel that interest rates, well, I mean, obviously they can fluctuate in value, so your actual debt costs can change. But generally speaking, if you look at from a standpoint of having debt against, so think of a rental property where you put 20% down in cash and 80% is a mortgage. So if that mortgage it hedge against inflation. So even though you have this 20% down, so let's just say it's a $500,000 property, you put 100 down. When you have a 5% inflation, that $500,000 house is going to increase by $25,000, and $25,000 is actually 25% of what your actual down payment was. So it's actually your cash into it is $100,000. If it goes up by 25 grand, that's a 25% return on your cash just in real asset gains. So what happens, and this is something that it's funny because you hear in the news all the time, funny, not funny, I guess, you hear in the news all the time about the wealth gap widening during inflationary periods. This is why, generally speaking, people that rely on, are lower income, don't have assets, rent their properties, or lease their cars, and leasing the cars doesn't matter, but generally speaking, the lower your income, the less you have of real assets, and real assets are what keep up with inflation. So in essence, the wealthy or the smart middle class that invest in real assets, they end up gaining wealth during an inflation period beyond the inflation, while others fall behind. So inflationary periods are never good for the majority of the population, that lack real assets.
So last thing we're going to talk about here for combating inflation is using infinite banking. So, we talk about infinite banking a lot in this podcast. Of course, infinite banking uses whole life insurance policies, and the whole life insurance has a cash value that grows tax-free and is unaffected by market volatility, which means you have constant compounding within your policy. So compounding, in essence, if you do not interrupt it, because it's a rising curve, it's bound to beat inflation as long as you don't interrupt it. And infinite banking provides you that ability to not interrupt your compounding.
Yeah, and generally speaking, the returns inside them are they're like savings account on steroids on a long-term basis. And of course, they're tax-free. So like the example I used earlier, 3% versus 3% in a taxable environment is you're eroding. But because these are tax-free, this is tax-free growth. That it tends to keep up with inflation. In fact, actually exceed, as Cameron mentioned there, the compounding effect. And think of that in terms of if you're thinking of the reverse of a mortgage, you pay less and less interest over time, but in a compounding scenario, you get more and more interest. It's really about volume of interest, and that volume grows over time to exceed inflation.
The great thing too is you can use policy loans in your infinite banking policy to acquire real assets, like we talked about. The real assets that are going to outperform inflation as well. So you could like you mentioned, the $100,000 down payment. Mm-hmm. Well, if you do that as a policy loan, well, you're starting to
you're
getting infinite returns now because you're not putting any of your own cash into these investments.
So yeah, and again, cash flowing business. Any time you can invest in something that has some pricing power. Against inflation, anytime you can invest in that, it is a great hedge against inflation, period.
So we talk all about combating inflation. It's now time to actually do these things, because doing nothing is risky. It may sound funny because you talk about the risk of investments themselves. Doing nothing might be the riskiest thing to do in an inflationary environment, because holding cash or putting cash into a low interest savings account, inflation kills it. If inflation's 3% annually, in 10 years, if you put away $100,000 today in a shoebox or under your bed,
or in a checking account that doesn't pay you interest.
In 10 years at 3% inflation, that $100,000 is going to now feel like $74,000. That's ridiculous.
But it was safe money.
Yeah, it's
there is risk in doing nothing. That's for sure.
Yeah, your real return is is a pretty significant loss. You wouldn't be too happy with your financial guy if they turned $100,000 into 74 over 10 years.
Exactly.
So, just to wrap things up for you guys, inflation is inevitable. You're not going to change it, I'm sorry to tell you. But smart strategies like investing in real estate, leveraging good debt, and utilizing the infinite banking process can help protect and grow your wealth amongst our inflationary environment. So please do take action on this. Doing nothing is very risky. You guys can check out the description. We have a link for a 20-point maximizer assessment that we'll provide for free to you guys to help figure out where you are at in your financial position today and strategies moving forward.
Yeah, and your efficiency, right? So this is all about efficiency. We talk about efficiency and control all the time. And going through this assessment, we'll give you some clarity as to where you're at from your basically your investment efficiency, your cash flow efficiency, your long-term planning efficiency. Nothing else. That 20-point questionnaire may take you 30 or 40 minutes to do. We'll give you that clarity.
Awesome. Thanks, guys. Please do like and subscribe, and we'll see you all next week on the Magnify Wealth podcast.
Have a great week, everybody.
Thanks for tuning in to the Magnify Wealth podcast with Scott Gannon. Remember to subscribe on YouTube or your favorite podcast platform for more insights on the infinite banking concept. Until next time, remember, immediate action is the most efficient way to achieve your goals.